Are you paying too much in taxes? The Green Group can help. There's a reason the most successful owners, breeders, and horsemen select the Green Group as their tax advisors. They save you money and share successful strategies. Over the past 40 years, the Green Group founder, Len Green, has owned and bred some of the best racehorses in the history of the sport, like Eclipse Award-winning champions Jaywalk and Wonderwheel. His DJ stable competes at the highest level and has received the game's most prestigious honors. Len Green's in-depth, hands-on industry knowledge, combined with cutting-edge tax-saving strategies, has produced positive results for his clientele and has made the Green Group the top-rated accounting and tax firm in the thoroughbred business. For a confidential and complimentary consultation, contact us at 732-634-5100 or visit our website at www.greenco.com. The Green Group, proven strategies to save you taxes.
Blood Horse Plus, available through bloodhorse.com, provides exclusive, timely, and unmatched content to subscribers, including Fox Sports, Blood Horse branded weekly programs, a detailed stakes winners section, behind-the-scenes videos from Blood Horse staff, on-demand access to deeper horse statistics, and a $5 monthly credit to equineline.com. Upgrade to Blood Horse Plus today.
Well, good afternoon. My name is Gary Falter with the Jockey Club, and I'd like to welcome everyone back to the 2023 series of online panels. And today we have our first panel that we're going to kick off talking about the topic of accounting and tax considerations for owners. So welcome, everybody. And before we get started, I'd like to recognize our sponsors, starting with our presenting sponsors, Bessemer Trust, Stoll Keenan Ogden, and the Green Group. I'd also like to thank today's panel sponsor, Mersant International, and our question and answer sponsor, West Point Thoroughbreds. And the support of all our sponsors make it possible for us to offer these panels at no charge to you. Now, if you've attended any of our past online Zoom panels, you may remember that we held the question and answer period to the very end of the discussion. And so we're going to make a slight change for this panel. And the format we're going to follow is in about 10 to 15 minutes. If we have some questions in the Q&A queue, we're going to pause, answer your question, have some conversation about those questions, and then move back into the panel. So please be sure to use the Q&A button that's at the bottom of your Zoom screen to submit any questions. And two suggestions I can make about your questions: try to keep them short and relevant to today's topic. And if we can't get to all the questions, our panelists have been kind enough to offer to answer your questions offline after we're through today. So we'll have two different sessions of Q&A. We'll stop at about the 10 to 15 minute spot. If we have some questions in the queue, answer those, go back into our presentations and discussions, and then we'll have more questions at the end. So I'd like to introduce our panelists today, starting with Mr. Len Green, who's a CPA. Len, maybe you can wave and let everybody know where you are. Len is the founder and chairman of the Green Group, and Len's had a long and distinguished career as an entrepreneur. He's been recognized nationally as a tax expert and family business consultant. The Green Group is widely regarded as a top-rated tax and accounting firm specializing in the thoroughbred business. They consult and assist over 800 clients within the thoroughbred industry. So welcome, Len. Glad to have you. Next is Aaron Yagoda. Aaron on to the left, there you are. Aaron's been in the thoroughbred business almost 40 years and can be found at the barns in the morning and at the races in the afternoon. And over that period of time, he's successfully owned horses at just about every racetrack in the country, from $5,000 claimers to graded stakes performers. Aaron is a board member of the New York Thoroughbred Horsemen's Association, and he's a frequent guest on the Steve Bick Show and other podcasts. So welcome, Aaron. Glad to have you here.
Thank you, Gary.
And next is Jonathan Green, a CFP, which is a certified financial planner. Jonathan writes to my right. Jonathan manages one of the largest racing and breeding operations in the country, DJ Stable LLC. And under his guidance, DJ Stable has enjoyed international racing success including 2 Sovereign Awards in Canada and a pair of Eclipse Awards. 14 leading owner titles, over 150 stakes race victories, and almost 2,500 overall wins. Those are some pretty impressive numbers. In addition, DJ Stable has bred 24 Grade 1 performers and sold over $87 million of horses at public auction. And I'd just like to congratulate all 3 of you for being involved with the champion 2-year-old filly, the Eclipse Award winner Wonder Wheel. We saw her video there in your ad, and a huge congratulations for that Eclipse Awards.
Thank you. But this ranks up there, Gary, as far as all the achievements that we've had. So we hope that this is going to be a great session.
Okay, great. Yeah, I agree. Okay, so let's get started. We got a lot of topics to cover. And I think the first thing I'd like to have you guys talk about is why it's important that owners, especially newcomers, understand the cost of owning racehorses and any likelihood of profits or earnings, and how to reduce some of those costs if there are opportunities to do that. So maybe Aaron and Jon, if you guys can talk about, what are some of those costs, and so that people come into our business with their eyes wide open on the fact that this is an expensive business to invest in.
Well, I mean, the first thing you have to do is talk about, you have to have your, find a trainer, hire a trainer, and you have your daily training costs, which will be about 3/4 to 80% of your training monthly, bill on the horses. And they range anywhere from $65 a day to $125 a day, depending on where you're racing, what circuit you're running in, and all that. And then there's other costs associated with that you also have to take into consideration.
You're talking about anywhere from another $1,000 to $3,000 a month. That constitutes veterinary bills, vanning, blacksmith, travel, race expenses. And the one thing that we found over the years in doing our own analytics is that there's really not much price difference between campaigning a $5,000 claimant horse or campaigning a graded stake winner. The expenses are almost the same. The fixed costs are almost the same. The only difference is going to be if you have a better horse, you're going to spend a little bit more on investing in stakes nominations, and maybe a little bit less in vet fees. But otherwise, it costs almost the same amount of money, irrespective of how good or what level the horses are running in. So you have to consider that, as fixed costs, and understand that it's going to be roughly $5,000 to $6,000 a month all in if you race at any of the major racing jurisdictions. That would be California, Florida, New York, Kentucky.
And that's not even covering the cost of the horse, which is
Right.
on top of that as well.
Right.
And the other expense that would be variable is what the cost of the horse is, the insurance that you have. You buy an expensive horse, if you want to insure it, that would actually fluctuate by the value of the horse. So that's something else you'll have to keep in mind when budgeting.
So it sounds like there's a couple variables, veterinary costs and insurance, that could cause your annual cost to either be a lot higher or a little bit lower. You talk a little bit about the whole veterinary side of it, because some horses stay very healthy and don't require a whole lot of vet care, and some horses have some nagging injuries. I mean, what are your experiences as owners and just how those costs could vary as it relates to veterinary costs?
So I looked at some of my past bills before today's conference, before today's Zoom call, and my horses usually range between $200 and $800 a month on average, pending nothing major that goes on. It also depends on how many times that month that horse races. The more time it races, there's more pre-race medication, at least for now. Also, there's something called race day expenses that a lot of trainers are starting to add to their bill, because there's overtime and the way the labor rates are, that it's costing more as well. So every time my horses are running, they're costing anywhere between $100 and $150 on top of that, just for a race day expense, including the veterinary bill.
Okay.
When you're talking about the other variable, which is insurance, a lot of people opt not to insure their horses. And in horse racing, unlike other forms of industry, there is no performance-based insurance. So what you're buying is strictly mortality insurance. You're buying life insurance on the horse. And depending on how much you want to take on the risk yourself, depends on, will vary the amount of money that it costs to insure that horse. For the most part, the major 3 insurance companies. There really are only a handful that are out there that will insure thoroughbreds. You're talking about anywhere from 1.25% to maybe even up to 5% of the value, and it really depends on, is that the only horse on the policy? How much are you insuring the horse for? What deductible you're willing to take on and insure yourself? So, like anything else, you can get a volume discount. So the more horses you have on the coverage, the less the percentage will be to insure those. But of course, the price will go up because you're insuring in mass. You can take on some additional deductibles as well to lower the insurance, but there's a whole host of different options that you can have with regard to mortality insurance and the horses. And you may sit down and say, I don't want to insure my horse if it's less than X amount. I know without giving away any company secrets, we self-insure to a certain point.
Okay.
Rather than insure every single horse for every dollar that's out there. And we found that by willing to self-insure and take on a higher deductible, that lowers the overall insurance rate enough where it's palpable for us to go forward with it.
Okay.
Gary, people say, why didn't the flight line keep on running? But the insurance cost to carry that value was just so high that was one of the factors, I'm sure.
Okay, yes, I remember reading about that. So is it safe to say that to have a horse in training, it's going to range from anywhere from $40,000 to $60,000 a year? I mean, depending on the jurisdiction that you're racing, and it might not be as expensive in Ohio as it is in New York, but it's going to be in that $40,000 to $60,000 range, and that doesn't include any extraordinary veterinary cost and how much you want to insure the horse for. Now, there's one other expense you guys haven't talked about. It's an expense you'd like to have, and that's when your horse wins a race and you got to pay the trainer and the jockey. I know that's an expense, so talk about that expense.
Well, that's a great expense to have, right? That, and you want to owe the track photographer, because then at least you know you did something right. But there's an expense that we're not talking about. A lot of people are doing now in some of the major circuits. There's a lot of owners and trainers are going on deals where the owner puts up the money and the trainer's paying all the costs, and they're splitting a revenue share of purses and expenses. And that's something I was going to ask Mr. Green later about, how do you handle that for tax purposes? But a lot of owners that are knowing going in, they're basically going in, they know what their cost is going to be. It's the price of the horse, and then the trainer's picking up that expense, which, it's treading on not the greatest business plan, but a lot of people are doing that these days. So that's something else.
What I hear you're saying, Aaron, that's a way to reduce some of those expenses by having some kind of an arrangement with the trainer.
Right. That is correct.
Okay.
And not every trainer is willing to do that. The more established trainers usually don't want to offer that kind of an opportunity, whereas the trainers that need horses or want to be a little bit more experimental in their thinking, they're willing to take on some of that additional risk in order to get new owners to come aboard. So you're not going to be able to call Todd Pletcher or Chad Brown or somebody of that caliber and say, hey, would you take this horse on a deal? They're going to hang up the phone. But there certainly are a tremendous number of trainers that are willing to at least you think about something like that, especially if they feel like that the horse has the opportunity to earn some dollars and ultimately get their win percentages up higher. And that gives them an opportunity to get more horses in.
Okay, now before we jump into accounting and taxes, just take a moment to talk about the opportunity to have some earnings. I mean, purses seem to be higher than they've ever been. I just read the Equibase report yesterday that the purses continue to go up. We see maiden races in the $100,000 range, $70,000 range. Just talk briefly about, how have things changed in the last, say, 10 years in purse structure and the opportunity to maybe offset some of those costs or possibly even earn some purse money.
Well, the purses are at record levels. You really have a chance, especially in New York. You could now win one race a year and cover your whole yearly expenses, which was almost unheard of years ago. I mean, $50,000 claims used to run for a $20,000 purse with about 60% to the owner. That's $12,000. Now those horses are running for a $75,000 purse, and you're getting almost a whole year's of expenses covered by that. In fact, I own a horse with Mr. Green and John, a little filly. We had Ontario, and we took advantage of running her up in Canada, being Ontario side and a Canadian bred. And we got $75,000 back out of a $110,000 purse just with all these extra bonuses. So that's another thing you look for. You look for state breds or any other state incentives or where you can actually get extra money just for racing in that jurisdiction.
Not only are they running for more money, but they're restricted races. So you're only running against horses that are also eligible for the same restriction. So whether it's like Aaron said, Ontario sired or Ontario bred, which are two different things actually, or New York regional, Maryland regional, et cetera, but there's also some racetracks that are offering races for horses that have been purchased at a public auction for under a certain limit, under $50,000, for example. So you'll have an opportunity to run your horse against other horses that have also been less expensive purchases at sales versus going against the big guns and the $1 million yearlings and things like that. So I think when you look at a catalog page at a sale, you have to look at it from top to bottom. You have to look at who's representing the horse. I know I'm going a little bit off topic, but you have to see who's representing the horse, the pedigree, the family, experiences and how well they've done race record. And at the bottom, it's going to say what restricted races the horses are eligible for, anywhere from the Breeders' Cup all the way to New York sired or restricted races, Delaware certified. So all of those different pieces of information at the bottom of the catalog page are very influential and should account for, when you're trying to decide how much to spend on a horse.
Okay, well, that segues nicely into the next topic I want to cover, where we can kind of get into accounting a little bit and budgeting, is the importance of having a business plan. Years ago, when somebody would mention business plan, I would shudder and think, oh golly, it's got to be something very complex and comprehensive and goes into a lot of detail. And I've even heard people say you can write your business plan on a napkin and just file it away, just have one. So talk about, if you could, Len, the importance of having a business plan and budgeting and why that is important.
It's important for a couple of different reasons, Gary, and the audience. And again, if I can emphasize again, the reason why I think this panel it really gives value is we're not only going to give you a theory, we're going to give you the actual so that you can use it. Okay. And what happens here is that if you don't have a business plan, well, then you're going to be sucked up into the fact that most people in the business lose money. Well, they lose money if in any kind of business that you go into, if you don't have a strategy and a business plan. So it's not so crazy to make sure that you do have something. And in that, you decide at what level of racing do you want to be in? Okay? Do you want to be at the highest level? Do you want to try to win the Kentucky Derby? Well, then you'll try to buy colts. Do you want to try to have a diversified portfolio with some colts and some fillies? Do you want to have diversified in the sense that you also want to have claimers? Do you want to have speed horses? Do you want to have distance horses? Do you want to have turf horses? And each of those, once you decide what level you want to run at, then you got to get the right kind of horses to fit that particular business plan. And then you have to select the right kind of trainer, okay, who will work with you in that area. And there's certain trainers that are better at certain things than others. Okay, there are certain established trainers, and there are certain hungry trainers that were just starting out. And all those different mixes and ingredients go into deciding where your business plan is, and then how much money do you have? Okay, do you have just enough money so that you can only buy one horse? Well, then don't buy just one horse, get into a syndicate then, because you buy a smaller leg of a horse, but you also start learning. And there's a learning curve to this game. And the important thing is to get into the learning curve without it bankrupting you. Okay. So again, the business plan has to be flexible. Yeah, you're 100% correct. Okay. And you have to be able to pivot. Okay. You're going one way and it's not working. You got to go another way and try it. But it's very, very important that you have good advisors. It's very important that you have these kind of sessions where you can ask questions. I mean, it doesn't cost you anything to ask a question on a panel like now. But if you don't ask the question, you go ahead and do something without that knowledge, it's going to cost you a lot of money. So again, that's part of your business plan.
And from a IRS standpoint, doesn't the business plan add a lot of credibility to?
Yeah, again, later on, just jumping that I'm going to get into it in detail. There was something called the Skolnick case that just came out, and the banner was IRS wins important case against horse owners, okay, because they turned it into a hobby. One of the greatest cases in the world, because this guy did everything wrong, including having no budget, no business plan, okay, commingled his personal with his business. And I kind of get into that a little bit later, but they didn't have that. And so if you not only want to try to make money, Gary, but you also want to withstand IRS scrutiny, you got to have these kind of things. And it's important that you sit down with your accountant or advisor and so that you can work something out that you can feel flexible enough with.
Well, I think the importance of a business plan can't be overstated. And in 2 months in May, we're going to actually have a dedicated panel with panelists that are going to take a deep dive into creating a business plan and all the different elements. So I know we've just kind of hit on the surface, but I think it's safe to say that you feel it's very important to have a business plan coming into this business, and even those who've been in the business for many years to have that plan. And you can pivot and it can change, but to have that plan.
And have a lot of napkins.
Okay. Hey, I want to pause here for a second and just remind everybody, if you have a question, please submit it. We're going to keep going here, and if we can get a few questions, we're going to pause and answer those questions and then keep going. So if you have a question, just tap the Q&A button and submit it, and we'll stop and then and answer your questions. But let's go ahead and talk about budgeting. Now, where does budgeting fall into this whole thing? So we just talked about, the cost of owning a racehorse and all the different elements. I mean, from your experiences as the Green Group, is that something that a lot of owners forget to do, or they don't do a very good job of, or do you feel that most owners are pretty tuned in to having a solid budget?
I would say, Gary, that when they go to an auction, they start off by saying, hey, I think I want to spend X amount of dollars. If you want to say, Len, what's your experience with that? My experience is almost everybody goes over their budget because they get caught up in the auctioning, and then they almost tend to think that they're bidding against somebody else. Okay, that person's not going to outbid me. And there is a result. And boom, their idea of how much they were going to spend this year, or how much they're going to allocate to horses, goes right out the window. So that's the first stumbling block. And if you would just put in the back of your mind, there's more horses than there is money. So that there's always another horse. Okay. But having said that, let's say you say, I want to spend X amount of dollars. Okay. And I can afford to lose X amount of dollars, and it won't change my way of living. Okay. You start with that, and then you say, okay, I think I'm going to spend X amount of dollars on horses. Wrong way. You start with, what would the cost be, as you started before, of owning that horse? So I know, okay, I put that much aside. If I buy 2 horses, I go almost twice as much, etc. At that point, am I still okay? If the answer is no, I'm not, well, then you say, hey, do I have any friends, family, fools, but whatever, okay, who want to be partners with me? Okay, and again, or do I want to go into a formal partnership, okay, who will help me, with all the aspects of it, because they'll go out and buy it. Okay, so I know exactly what I'm spending for that cost of horse, because that's the price to get into the partnership. And some of the partnerships are, that's a one price, covers all. Others, one price plus a maintenance fee. But you at least can very easily manage your budget, because you know exactly what to do in those situations.
Okay. Hey, I think we're going to pause now because we have a few questions in the Q&A queue. So let me bring those up. And here's a question. Do you always match the trainer with your plan for specific horses? So you're selecting a trainer. If you've already purchased your horses and you have certain horses, do you try to match trainer with those specific horses. What are your thoughts there?
Yeah, I'll go first on this one. We absolutely do. There are certain trainers, just like anything else, they're specialists. And there are certain trainers that are much, much better than others at getting horses ready early. Wesley Ward comes to mind, for example. And so if you want to have that immediate return on investment, you hire a guy like Wesley. There are certain trainers that are much better at developing 3-year-olds. So you give horses to those kind of trainers. And there are certain regional trainers that excel, at their local jurisdiction. So again, if you have a regionally bred horse, you may want to give it to a trainer who campaigns horses in that area. But I think it's like anything else. I think that at this stage of the game, the horse industry has gotten very specialized.
Well, like the horse we bought was a Ontario sired horse, Canadian bred. We'd be fools not to have it in Canada, right? Or you have a New York bred that's a registered New York bred. You'd like to race where the purses are the highest, that would be in New York. So sometimes the horse dictates, but then you could then narrow it down, filter it down by what trainer you think did the best with New York breds or sprinters, or like John said earlier, whatever type of horse you think would fit.
And the other thing that we do, again, this is just what we've found has been successful over the years, is that when we go to an auction and we have a short list of horses that we like, we will hand that list off to a couple of trainers that we work with and basically allow them to pick and choose and rank which ones they like the best, with the idea that if one of the trainers absolutely has, an intermission colt that he loves more than anything else on the list, if we end up purchasing that horse, you try to match it up with a trainer that really liked that horse. One of our top trainers, Mark Cassie, who's dual Hall of Famer in Canada and the United States. And you would think, Mark's won with turf horses and dirt horses and young and old and everything in between. There are certain sire lines that Mark doesn't like. Mark doesn't like Malibu Moons. So I don't even show him the horses that have Malibu Moon in the family. He doesn't like violences. So even though Forte won, the Eclipse and is the favorite for the Derby, he didn't make our short list because
I bet if he had Forte in his barn, he wouldn't be kicking him out.
That's true. That's true. Exactly. But you'd be surprised because when you look at 100 violence yearlings, that's all they are. They're just yearlings at that point. There's nobody has the crystal ball. So Mark doesn't really like to train violences because his experience has been that he can't get the most out of them, whereas other trainers do. So we really try to match him up, so that way when a trainer gets a horse, they're excited about that horse. It's not just, oh well, I got this horse and I wasn't at the sale, I wouldn't have picked it out, and they immediately have kind of a bad taste in their mouth about having that horse in their barn every day. You want the trainer to wake up every morning and the first thing that trainer thinks about is your horse.
Okay, a few more questions in the queue. I'm in Saratoga. It's hard to find accountants and attorneys who really know how to advise. How do you find someone with the experience and their last name is not Green? So yeah, how do you find someone to assist you from an accounting and attorney standpoint?
I'm not sure that you need to have somebody in Saratoga with you. Okay, as I said, we have 800 clients and we only have about 22 of them that live in New Jersey or New York. It just isn't that hard. Okay, with computers, et cetera, kind of thing, with the programs that are available and the apps. Okay, you can get all your information together. You can send it to a secured portal. Okay, plus the fact that a firm like ours, okay, we're down in Kentucky 4 times a year, at least. We're in Florida 8 times a year. We're up at Saratoga. We're in New York. It's so easy to do it. And what you want is, if don't necessarily have to use us, but use somebody who's knowledgeable in the business, who not only knows that 1 and 1 is something, but also can give you advice because they're in the game and they can spot things and look at expenses and know which expenses are out of line and which ones are not out of line. If they look at insurance and say, hey, your insurance is high, why don't you do deductibles? Why don't you do this, that, and the other? You need somebody who knows something about the business to help you.
I mean, I'm a client here as well, and that's how I had a different accountant, and we had all kinds of trouble with my horse business. And I figured Mr. Green is kind of like that insurance commercial. He knows it all because he's seen it all, either firsthand or not. And that really helped me get, out of a little jam that I was in. And then I stuck with the Green Group even for my regular business. But it's really nice to know that, most of their things Mr. Green has seen firsthand, being an owner for so long. But if not, he's represented so many people that someone else has been in that same boat I have. So it's a big
Okay.
advantage to have a specialized type of person in that industry.
Well, and I'd like to also point out that on ownerview.com, we have a wealth of information. It's all free. It's available to anyone that wants to go there. We've got a section titled Advisors, and these are men and women who've made themselves available to be a consultant, advisor. Many of them are owners. Some of them are agents, some insurance, some accounting, some legal. So, feel free to check out Ownerview in the advisor section. And you'll find a lot of valuable information there. So a couple more questions.
Gary,
Go ahead,
also
Len.
on Ownerview, okay, they have a great section on traders, which gives you percentages that they've won with different kinds of horses, et cetera. So if you, for instance, claimed a horse, okay, you would go there and say, okay, what trainers are really good with claimers? Okay, and it's all there, okay, on your section.
Yeah, we have that whole section for every active trainer in North America and all their stats, every racing syndicate that we can identify and their statistics. So again, it's all out there for you to view, and it's all free. I've got a couple questions that are tax related, and I'm going to hold those to the end because we haven't gotten into the tax portion yet. Let me go to this question here. Can you please ask the panelists if there is a certain threshold where you decide to have an insurance policy versus foregoing the policy on that horse and self-insuring? Is there a threshold, or is that more like of a personal?
Yeah, I mean, it's a personal preference, but when we've done the math for our operation, for example, we sit there and we actually put it on a computer spreadsheet and say, okay, for every additional dollar that we insure, how much is this going to lower the overall rate? So we're actually getting down to that kind of an analysis. For most groups or most owners that have a smaller number of horses, I think it's pretty straightforward. If you feel like that this horse is that you are considering to insure, if they're irreplaceable, or it's going to be very difficult to go to market and find something comparable, then you would want to insure it for the full value. If it's something that it's, and if you take the personal side out of it and you say, what is this horse really worth to the general market? Not, I named it after my wife, so I love it, or I grew up on my farm, so I want to kind of keep. If you look at it strictly as an asset, as an unnamed asset, it's a widget basically, and say, what is that horse worth to the general marketplace? And can I replace it at that price? That's really, almost like what we were talking before we got on about, Aaron's business. Is the factory worth what, what's the replacement value for the factory? And you almost have to look at it that way, is how much is it worth and can I replace it easily? And if the answer is no, you can't replace it easily, then you want to insure it for the full value.
It's also very fluid, though. You don't have to say, I want to insure this horse for X. I mean, as your horse gets better, like I stay in the $25,000 to $75,000 range when buying. I'll insure one once I think that horse gets to $100,000, and that might be just because a half brother or half sister just won a graded stake race. So, and then I could cancel the insurance. I could increase the insurance. It's not like you pick one price like you're buying life insurance and that's what you have. So it constantly changes, right? Like Wonder Wheel won the Breeders' Cup, her value went up. I'm sure they increased their insurance policy on her by a lot. So it's very fluid. You don't have to have that set in stone type of expense.
Okay. So let's get back to the panel discussion, and to our audience, if you have additional questions. And I know we didn't get to all the questions that were in the queue. We're going to have some time at the end to field a lot of those questions. So if you continue to have questions, just use the Q&A button, and when we wrap things up here in the next 20-30 minutes, we'll go back into those questions. So Len, let's talk a moment here about the pros and cons of a partnership versus an LLC versus establishing yourself as a corporation. So what are some of those pluses and minuses and principles that you advise folks about?
Yeah, okay. Again, I think what you don't want to do is keep the horses in your own individual name. It doesn't help you from a tax point of view, and it certainly doesn't help you from a potential liability point of view. So the next logical step is to incorporate yourself. Well, I don't want to hire an attorney for thousands of dollars for $250, you can become an LLC yourself. Okay, what does that do? Well, that gives you protection, number one, because you're a corporation. And number two, it opens up the possibility of having more tax deductions than you would have available if you were an individual. Now, if you want to put whipped cream and cherry up on top, well, then you'd have a two-person LLC, because that gives you even more benefits, or a subchapter S corporation. But the important things are, number one, protect yourself, because that horse can kick somebody or do something, and you don't want that. And then number two, you get into, well, if there's tax deductions and I want to be able to utilize those tax deductions, what vehicle gets me from point A to point B the fastest? And that's the two-person LLC or the subchapter S corporation.
And Gary, the other thing that I would probably add in there also is that it not only gives you legal protection, like you mentioned, some flexibility from a tax standpoint, but doesn't it also add credibility to the fact that you're running at it as a business, especially if you keep separate books?
It certainly does. Again, keep on pushing that down the road, but a lot of that comes into consideration on each of these things, Jerry.
Okay.
Thank you, John.
Just one more area on accounting before we jump into taxes. So I think it's important. We talked about budgeting and having a budget and know what you want to put towards your daily expenses and so on. How do you recommend owners keep track of revenues and expenses? I've seen it done where, an owner will keep track of things on a horse by horse basis. So they get their invoice from the trainer and they log things into whatever system they're using, and they apply it by horse, and even keep a P&L per horse. And I've seen where owners have done this just for their general stable and keep things at a higher level, and they don't get down to the horse level. So from your experiences with the Green Group and as owners, what's your recommendation there? I assume you recommend that everybody does keep track of their revenues and expenses on a regular basis. Sure. So we'll skip that, but what's the best way to do that?
Yeah, and Gary, we actually do both. We actually keep it as our stable entity and kind of a 30,000-foot view, and say, how are we doing overall as a business? But we also break it down by horse, so that way we can do analytics and say, this year how were the claiming horses versus the allowance horses, or the allowance horses versus the stake horses, or stake horses from 2023 versus stake horses from 2021 or 2019, and so on. So we're constantly using that information and massaging that information for our own analytics. From an accounting standpoint, if you're keeping it all under one entity and one stable name, then from a tax standpoint or an accounting standpoint, that's the important thing to do. But we actually break it down by horse and by type of horse, and that way we can go back and over years and see what we've improved upon or what we have done better previously, and can reinvent and bring into it this year. That's the advice you give your clients, right?
I certainly do, and we actually go even a little further than that. We actually go back and see, okay, which of these horses did well? Then let's go back to the sale, okay, that we bought them in, okay, or how we bought them, and do we buy them privately? And what was the logic and thinking behind that? And did it work out or didn't work out? And you can't do it on one horse. You have to do it on a mass of horses. So, and suddenly some things come into play. If you're going down to the September sale in Keeneland, what are the percentages of horses in book 1 that do well versus the cost? Book 2, book 3, book 4, book 5, OBS. And when you do that, and you look at the notes and you see, okay, and you see what's happening, and we were joking before about Forte, okay, and you say, well, gee whiz, what a great buy at $110,000 or so, and yet he jokes. It says, I bought 2 violences, okay, one for $1 million that's pulling a cart in Central Park, and one for $110,000. Okay. So again, you're not going to know, but you're going to see a pattern in things, in these things, if you look at it close enough. And if you don't have records, then you can't do analysis. If you can't do analysis, you're not treating it as a true business.
Well, do you recommend programs that owners should have access to keep track of all this data, all these expenses and revenues and by horse and for the stable? I mean, QuickBooks, Excel. I mean, I even know that Equine Line Portfolio Service has a expense and revenue center that you can keep track of all your transactions, and it has some very nice reports. It's all part of the portfolio service. What do you tell your clients? What do you, I mean, you don't want to get a bunch of receipts in a shoebox at the end of the year and say, here, figure this out. I don't know if I made any money or how much I lost.
Right. And the shoeboxes, okay, can't have a budget and can't have a business plan because they're just throwing everything together. And I think for the more expensive horses, okay, we do a more detailed type of analysis. Okay. And for the general, okay, we use the normal stuff. Okay.
And for record keeping, I keep it a profit and loss for each horse as well. And I do it on a little simple spreadsheet. And I just hand to the Green Group, not my individual. I add up all my training costs and hand over those in buckets to the Green Group, and then they'll give me back what my depreciation, on the horses are and all that. So I have my cost basis on the horses. So I keep a running total of profit and loss on each horse. But in terms of tax purposes, so you don't run up a big tax bill and you don't run up a big accounting bill. You just send it to them in buckets. I had X amount in blacksmith, X amount in veterinarian, X amount in training, and these are the horses that I had left at the end of the year.
And Gary, you want to do one more thing too. You want to know where you are during the year. So if it looks like, okay, you're having a very good profitable year, okay, and you're in September, well, then hey, maybe I should be buying horses in the September sale. Maybe I should buy horses in October, November, December. You want to be able to know that, okay, so that if you want to go to a sale, you say, hey, if I go to this sale, part of the money I'm spending is money I would be paying in taxes if I didn't buy more horses. So it's really important to treat this like a business, not only to withstand IRS scrutiny, but just to give you a fighting chance, okay, of making money. I mean, again, we could be glib and say it's very easy to show a profit and very easy to say you're not a hobby. Just go ahead and have a Breeders' Cup horse.
All right, or a Derby winner. I mean, here we have Rich Strike, charismatic, and Mind That Bird all ran for maiden claiming races and end up winning the Derby. So, all right, let's talk about some tax considerations. How do I maximize my deductions? What are some of the new tax laws that are out there? Can you guys talk about? I'm just going to throw a bunch of stuff at you. Capital gains. How do you set yourself up so you're not looked at as a hobby, you're looked at more as a business. So if we could, Len, let's just jump into some of the tax considerations that you guys deal with all the time and can advise the audience.
Yeah, and again, I'm going to try to hit the highlights for you. And again, I'm being very, very honest with you. If you have a specific question, okay, I'll be happy to answer. There's no charge for it. I want more people to be in the business as possible. And one of the ways they stay in the business is to be able to utilize the tax losses. So again, the big case I've mentioned before is called Skolnick, Skolnick. And that's the one that the IRS won. And you say, okay, why did the IRS win it? Well, the taxpayer commingled their personal and business. So you definitely want to start with have a separate account to cover your horse operations. Okay. Did they have any expertise in the area? Well, if they didn't, in this case they didn't, then you surround yourself with some people who you can ask questions for. Sessions like this or horse partnerships. Okay. Amount of time you spend in it. Okay. You can't be in business if you're only going to spend occasional weekends or just go to the races. That's not going to do it for you. You've got to spend the time learning this business and talking about it. And then you got to take advantage of the fact that, for instance, in 2022, it's the last year that you could buy a horse, expense it, and write 100% of it off. And you not only can write 100% of it off, but all you had to do was get title to it. You could have bought a horse in November or December at an auction, gotten title to it, and paid for it the following year, and you still can write the whole thing off the previous year, called an
So are you,
expense. Now,
can I interrupt you? Can you say that ended in 2022?
yeah, in the sense that 100% ended,
Right.
and then you go to 80%, and then 60%, 20%, so forth down the line. Even though it goes to 80% this year, you still, the other 20% is carried over. So there's certain flexibility. As far as capital gains are concerned, most people say, well, capital gains is 1 year. I know I buy and sell stock, not in the horse business. It's 2 years. You got to hold it for 2 years to get the capital gains for it. And so these kinds of, and then how many years do you write a horse off? I see so many people say, well, it's the same as any of fixed assets. So I write it off in 5 years. No, you write it off in 3 years, and you can write it off fast. You can use accelerated. Well, then I hear there's such a thing as Section 179 deduction, but I hear you can't use that and produce a loss. That is correct. You can only take that up to your profit and loss. But the expense provision, you can write everything up and actually produce a loss. So there's a lot of great things in the tax law. The more specialized you are in it, the more things you know that you can use and can't use for it. So many people buy farms and they say, well, that whole thing is either land and a few fences. No, there's paving is a deduction, fencing is the deduction. Well, the barns are a fixed asset that's usually 39 years. No, it's a special purpose asset. It can be written off in 10 years. So again, people who specialize in the business really know how to save you taxes and maximize your deductions. And you really want to be active enough to do it. And you do each of these things to make sure that you are active in doing it. I picked up a tax return the other day. Somebody said to me, I've been examined for 3 years in a row. Can you look at my return? And I looked at it, and it's accountant put down occupation, hobby. I think I know why he was examined so many years in a row. So again, I think it's important.
So Len, we had some, go ahead, John. Go ahead, John. Yeah.
Just jump in there, because at the end of the day, if you do have losses in the industry, and again, the old saying is 90% of people lose money in the horse business and the other 10% lie about it. So, you're up against it. It's a tough business to make money in. So at least if you have a profit motive and a business plan, and you don't commingle funds and all the things that Len just mentioned. But if you do have losses and you do it the right way, like you're explaining, then the other advantage is you write off those losses against your regular earned income.
Your regular earned income. If you're active, it's against the regular earned income. And even with the limitation on losses of 525, you still can, if you don't write them off in 1 year, you can carry them over to another year. But the key is to be active. And the key to having a chance to make money is to be active and keep records and see where you are, and then pivot and change the way you're doing things. Okay. If you
Glenn, can you take a deeper dive in this whole material participation? I mean, what types of things must an owner participate in to get through a tax audit that his or her horse business is looked at as a business, not as a hobby? What are some of those material participation elements?
Well, certainly listening to this seminar, okay, going to sales, watching podcasts, just reading horse-related paper, going to farms. If you go to sale, walk around with your trainer, ask questions, okay, all the time. I think the more knowledgeable you are, then hitting the 100 or 500 hour test is not that hard, okay, if you're actively involved in it. And again, imagine for a moment that you not only went to a Saratoga, okay, but you actually went for 3 or 4 days. And like I spoke last year at your seminar up at Saratoga. It was great. Most of the people have been up there for 3 or 4 days, Okay, now you start adding up being up there for 3 and 4 days, plus the travel to get there and the travel back. That's all horse related. So it's not hard to hit those titles. And then the more knowledgeable you are, the more you can enjoy what's going on, and the better chance you have of actually making money.
Okay, great. So, how do you maximize your experience if you buy and sell horses at auction? We're talking about racehorse ownership here, and having those horses at the track, but there's also members of our audience that want to breed horses, that want to sell horses. How do you maximize that opportunity from an accounting tax perspective?
Yeah, and Gary, I'm going to jump in and talk a little bit about, just from a opportunity to maximize that asset. Again, I'm a financial advisor, so I try to think of horses just like we think of stocks or mutual funds. And what we found over the years is that there are so many different types of sales and so many different sales throughout the course of a calendar year that you want your horse, if you're selling it, you want your horse to be in the upper third of whatever horses are being offered for that day. So that might mean that you have a horse that is a B average looking horse and has a B average commercial family. You could certainly put it into the Keeneland September sale where there's 4,000 yearlings that are being sold and hope that you get into a good day. Or you can say, like Aaron was talking before, if it's a New York bred, then you bring it to a New York bred sale where maybe it's not a B average looking horse compared to the rest of the horses that are at that sale. So I think you have to be realistic. And as long as you're taking a realistic look at your asset and you talk to a consignor and say, where am I going to have the opportunity to best sell this horse? And take the ego out of it and say, yeah, I would love to be up at Saratoga and sell a horse at Saratoga so I could tell all my buddies that, I was up there and sold a horse and raised the champagne like it looks. But if you bring a horse up there and it doesn't sell, then you're really behind the 8 ball because then you don't have any other yearling sales to put the horse in. So you have to be realistic and say, where is this horse going to be in the upper third? And why upper third? Well, again, statistically showing, we have found that if you're in the upper third, that's where the money starts to get, that's where the horses start to get chased after. And we call them a breakaway. So if you have a horse that's a breakaway horse at a sale, it means that it's going to sell for more than what you think the horse is worth. You always want to be in a breakaway situation because that means that there's a couple people that think that horse is worth more than everything else in that sale. And that's when it becomes a sales topper, or that's when it becomes one of the most sought after horses. And then it doesn't matter what your horse is worth. It's what those 2 people or 3 people's egos think that the horse is worth. So you want to try to set yourself up for a breakaway situation. And sometimes it means that you have to take a horse and put it into a lesser quality sale because it will stand out in that group. You want to be the best looking. You want to be the best looking person at the 2 o'clock closing call. Okay, that's basically where you want to be.
Okay.
And John, you do the breeding, okay? If your choice is to breed to an expensive horse, okay, who's proven, okay, or a first-year stallion which is sizzling, okay, what goes into that decision?
Yeah, again, it depends. It depends on what you're trying to accomplish. There's pros and cons. That's a whole nother. Gary will tell you that's a whole nother session, I think. And I know we only have a couple minutes left, so certainly that's a question. If somebody wants to ask us directly after hours, I'll be happy to. Any of us will be happy to answer for you. But I know we're up against the clock now. So
yeah, we do have some questions in the queue. So I want to wrap up our discussion with one last thing: giving back to the industry. What are your thoughts on ways that the owners and others can give back to the industry?
There's certainly a number of nonprofits that benefit the horse industry, and that we've donated money to. We've donated horses to, and you certainly get a wonderful tax deduction, but you feel good about it. And the way that we look at it and that we try to promote to our clients is when you buy a horse, you're buying a horse for that horse's lifetime. You're not just buying it for that horse's racing career. You're taking on ownership. And if you have an opportunity to repurpose that horse and retrain it to be able to have a second career. We really feel like that's what you're supposed to be doing with this horse, and not just, letting it fade away into oblivion, and worse, maybe showing up at a place that you don't want it to show up. So when you sign the ticket or you raise your hand and you're the winning horse at a winning person at auction, you really have to understand that trust factor and that responsibility is yours for that horse's life. So we're big proponents in giving back to the industry and trying to repurpose these horses to have a second career.
Well, because if you really think about it, their racing life is only a small fraction of their whole life. So if they're going to race for 3 years, maybe if they race 3 years, when they live to 20, there's 16, 17 years that they need a second part of the life. And, I know the Greens give a lot to aftercare, and in the NYTHA, we give a lot to aftercare. And that's a really important thing. It's like, we treat these as almost like your child, or they're like your dog. You have a responsibility, a social responsibility for that animal. Besides other charities, like other people on the backstretch and all the other great things that they do, the PDJF for the permanent disabled jockeys and the backstretch workers. And there's a lot of different organizations, and it's a really good chaplaincy, the racetrack chaplaincy. We're really like carnival people. We travel together, we share the stories and all that. And we really need to be responsible for one another as well, even though we're competing a lot.
Well, and I'll even add to that the Jockey Club Safety Net organization, right, where they support many people behind the scenes on the backside. So all good examples. So, okay. So, hey, that concludes our panel discussion. It went really fast, guys. Really appreciate everything. So now we're going to move into the final Q&A section. And while we sort through the question, I'd just like to take a moment. We can hear from our Q&A sponsor, West Point Thoroughbreds. We'll be right back.
How do you become the gold standard in racing partnerships? One horse, one partner, one victory at a time. Congratulations to all our partners who have made West Point the gold standard for the last 3 decades.
All right, so let me sort through these here. How quickly can a racehorse be depreciated? So that's the first question from our Q&A session.
Would you like the textbook answer, which is 3 years, or would you like the expense deduction, which is 1 year?
Which would you recommend?
Well, the real advantage of this expense allowance that most people don't realize is the fact that, again, Gary, if you have ownership of it, if you have the papers, if you bought it at an auction, okay, then you've taken title to it. And even if you haven't paid for it, you can take that full deduction in that year. It's a tremendous advantage.
Mm-hmm. Okay. Here's a question. What is the tax benefit of a 2-person LLC versus a single-person LLC?
Another great question, okay? A 1-person LLC would appear on your personal Form 1040 on Schedule C. You lay out all the expenses and the income, etc. 2-person, you file your own partnership return. So on your 1040, there's only one line, which is the result line. Okay. Plus, it also allows you then, if you're a 2-person LLC, to be able to be eligible to take other deductions, including the home office and travel, pensions, etc. kind of. So the real advantage to a 2-person LLC.
Okay.
And it doesn't have to be a 50-50. It can be a 99-1 partnership, and it still would qualify as a 2-person.
Okay. Here's a question. I understand besides the K1 tax form, there is now a K2 and K3 tax form. Can you please describe the difference and what triggers the generation of each form?
Great question again. And again, we do so many partnership returns, and we look at them, and that K2 and K3, you only have to use if you have foreign type operations. So even though it looks formidable, how come I have the K1? Okay, you can disregard usually K2 and K3 and stick with K1.
Okay. Here's a question. If I make a profit 2 years out of 7, does that ensure that the IRS will consider me in business and not in a hobby?
You know, that's another great question, because I would say that is the most asked question. Okay, do I have to show profitability at all? And the answer is that's one of 9 tests, 9 different tests, okay, to prove that you're actively involved in it and it's truly a business. So yes, it would be nice to have a profit in 2 out of 7, but that doesn't make you active and it doesn't make you in business. You have to have 4 other ones also. Conversely, you could lose money every year, okay, and you still have 5 other ones that make you qualify. The problem that you come up with if you lose every year and you stay with the same system is the IRS comes in and says, wait a second, you're not treating this as a business. You should be pivoting. You should be listening. You should be attending seminars. You do all those other things. So again, profitability is nice, but it's not the most important.
Okay. Here's a question. I'm in a few different partnerships. Each agreement is in my name. Can the K1 I receive from each partnership be transferred into an LLC with a different name that I create?
Well, again, it's a little bit hard now because of the matching process. Okay, it's going to have your social security number on it. So the IRS is going to be looking on your personal return under your social security number to see where that is. Okay, what we do because we do the accounting work for so many different partnerships is we say to the partners, if you have an LLC, please give us your ID number. And then when we do the K1s, we put it under that ID number.
I see. Okay. So when you talk about a 2-person LLC, does that incorporate 2 or more?
Yeah, 2 or more is correct.
Okay.
It has to have at least 2 or more. Yes.
All right. Okay, I got it. Let me go through. These are coming in fast and furious. Here's one. When it comes to a financial business plan, I've heard everyone has a plan until they get punched in the face. That really can apply to horse racing. I mean, you know, it's a business that has its ups and downs, that's for sure.
But Gary, pivot when you do that. If you're saying, I want to go to the Kentucky Derby, so I'm only going to buy colts, and you're losing money every year, step back and say, wait a second, even though a filly may not go to the Kentucky Derby, it may go to the Oaks or something, and it may have residual. Okay, so again, let's look at that.
Yeah, and I think, and some of the advice that we've given over the years with regard to business plans are that they have to be realistic. You can't say that I'm going to buy a $10,000 horse and my goal is to win the Kentucky Derby, and then show $100,000 of losses. The IRS is going to immediately come in and say that's not a legitimate business plan.
Okay.
So, you know, in that sense, like I know he was quoting Mike Tyson, which I think that's a great quote. You know, everyone has a plan until they get hit in the face. I think you have to have a realistic plan. And if your realistic plan is, I want to try to, you know, build a program, and this is the way I'm going to do it. The first 3 years, I'm going to lose money, but I'm going to have residual value in some of these horses that I'm going to carry forward. And this is, you know, I'm going to have regional horses. This is the plan, and these are the steps I'm going to take. The IRS is a lot more likely to accept that as a quote unquote legitimate business plan than just I'm going to go to a sale and buy one horse and hope that I can win $1 million with it.
I think before a business plan, sometimes you need to know what you want out of the business, right? So I'm never going to have a Derby horse. I'll sell it on the way. The only way I'm going to get to the Derby is the Greens are going to invite me. I'm going to go with them, right? But you need to know what you want.
Isn't great either. I wouldn't keep make that.
Is it a social aspect? Do you want to win racing at your local track, and then gear your business plan that way? But I think you really need to be, like John said, you need to be kind of honest with yourself. What do you want out of it? And then your socioeconomic background can determine the business plan you come up with.
Okay.
Gary, we were the leading owners. Okay, I remember how many times, 5 or 6 times, and we stepped back and said, wait a second, That's wonderful that we're the leading owners and we're losing money. What's the next step to do? Well, let's see, maybe we'll try to buy a piece of a stallion and try to support it and go out and buy fillies to breed to it. We lost money in that. And then keep on going through these things until finally John says to me, you know what, Dad? I have the solution. You step back and let me take over. Okay. And then we have Breeders' Cups and Eclipse Awards and things like that.
Okay, here's one last question, unless another question comes in as you're answering this. What allowances do I have for tax deductions when I travel to the races to see my horse? Can I deduct my mileage, my meals, my hotel, etc.?
What is the principal purpose for you to make that trip? Principal purpose is not only to see the race, but to talk to my trainer and have plans and strategies for the rest of the thing. So I'm going to spend time not only at the races, but I'm also going to spend time going over my business plan and changing it. If that's the principal purpose for it, then your travel and your lodging and your meals become deductible.
Okay. But here's a question that just came in. If you're in a partnership, can you deduct other expenses other than the K1?
If you're in your own LLC, okay, then certainly that is deductible. If you're in a syndicated partnership, okay, then it's very hard to be able to take those deductions, which is another reason why you would take the extra step of forming your own LLC and then going to the partnership and saying, please register it under my partnership name.
And Gary, you asked a question before about legitimacy of businesses and keeping them kind of separate. One of the things that I know the accounting firms recommended is that if you're going to have a separate bank account for your for your horse related activities, which is important to do, you should also have a separate credit card dedicated just to your horse related activities. And the reason why it's so important is not only does it segregate the expenses, but it makes it really easy from an accounting standpoint to literally just give your year-end tax statement on that one credit card to your accountant, because they know that the majority, if not all, of the expenses on that credit card are going to be for your business. So it's kind of practical advice, but it's really, really easy to show, and it's really easy to account for afterwards. It's going to save you money in accounting fees by doing it that way.
Sure. A couple more questions just came in. So I live in Las Vegas. I go monthly to Maryland, and I'm assuming they're going to Maryland to see their horses. Can I deduct everything?
Same principle. Are you going just for a race, or are you going to sit down and go over strategy, what have you? If the principal reason is a business purpose for going there, well, then it becomes, it's that principal purpose for doing it. Let's say you're going from Las Vegas to Maryland, and you're spending one day at the races, and you're spending 10 days, okay, doing personal. Well, then 1/10 of it.
Okay, good point. So we set up a plan to pinhook a few horses and then use some profits to fund some yearling purchases to race. Of course, we lost money, and now we have to fund our yearlings for another few years. Is it possible to end our LLC and keep our yearlings without creating liability of personal ownership, or would you continue the LLC? Kind of a long question, but I don't know if that.
Yeah, I guess the follow-up question would be, have any of the partners changed within that original LLC to the, you had 5 people that were doing the pinhooking operation, and only 3 of them are remaining for the racing. If that's the case, it's a different answer than if all 5 people are staying, for the entirety. If there are details, whoever asked that question, if there are details that you want to forward to us, we'd be happy to give you a more specific answer. But I don't think any of us want to give the advice based just on the information so far. We need a little bit more information.
Okay, and the person did say there's went from 5 down to 3. So, but that's a good point, John. Anyone that has a question after we wrap up this panel, send me an email. I'm happy to forward it on to John, Len, and Aaron, and you can continue some of these conversations. So here's one that just came in. Can I fund my racing LLC by transferring money from my personal account?
Yeah.
Okay, that sounds
The
logical.
the only thing you don't want to do is take money out of your pension plan. Do it with, because that
Okay.
would be not necessarily a safe investment.
Okay. Here's one. Is HISA having any effect on tax issues?
HISA's not having an effect.
Yeah, again, that's probably a whole discussion for another time of why we believe so much in HISA. Okay, and yes, there are extra costs involved in it. Okay, to be part of it, but it's doing such great work. Okay, that we are strong supporters. Okay.
But from a tax standpoint, it's not changing any of the tax
No.
rules or any tax.
Okay.
Absolutely correct.
Okay, might have some additional expense, but doesn't change the, okay. Hey, I think it's a good time now to wrap things up. My thanks to our three panelists, Len, Jon, Aaron. We really appreciate you giving us the time and giving all of our audience the time. Yes, Len.
Gary, are you going to have available the slides? I know I didn't get to say Shannon put the slides up, but they are there.
We have them, and we can share them. And again, if anybody has follow-up questions, please email me. You have my email address from the email I sent out this morning. And we'll be glad to share that with the panelists. And if Len wants us to share those slides, we can be happy to do that. So again,
Okay.
my thanks for your time and for your expertise. Great panel. We'll be back again in April, on April the 4th. With a handicapping panel. I'm excited to do that. We've had a lot of owners ask us about a handicapping panel to not only talk about different ways to wager, but also how to handicap a race that your horse has been entered in. So we've got four experts that are going to be on that panel, and I'm excited to do that one on April the 4th. So until then, I appreciate our audience for being here, being with us. We appreciate your investment in the industry, because without owners, we just really don't have a business. So
Again, may the horse be with you, right?
may the horse be with you. And hopefully we'll see you again in April. Thanks, everyone.
Thanks, Gary. Nice job.
Okay, appreciate it.